Quick question. When is your next dividend payment? Not the amount, the date. The actual week it lands in your account. Most investors can't answer that. They know their yield, they know their positions, but they have no idea when the money actually shows up. Josh couldn't answer it either, so he mapped it out and found a way to get paid every week. In this video, we're showing you how 12 dividend stocks, each assigned to a specific week, covering every month with 0 gaps. You'll see the stocks, the timing, and the real income this produces. And in the end, I'll show you how this system generates $250 to $350 every single week of the year. But first, let's talk about why this matters right now. Prices are still high. Groceries, gas, rent, inflation hasn't disappeared. It's just slower now. And while interest rates have climbed, they're not helping the average person save or borrow any easier. On top of that, markets are swinging. Trade tensions, political uncertainty, global pressure. Volatility isn't going away anytime soon. In that environment, chasing growth stocks is a gamble. One week they're up, next they're down 15%. Most people can't afford that kind of emotional roller coaster with the money they actually need. That's exactly where dividend investing wins. You're not betting on a stock going up. You're owning a piece of a real business that pays you to hold it. Market up, market down. The cash still hits your account. That income doesn't depend on timing the market. It depends on owning the right companies. But here's what most dividend investors miss, and this is the part that changes everything. It's not just about what you own, it's about when you get paid. Think about how you actually live. Your rent goes out the same week every month. Your grocery bill hits weekly. Your subscriptions pull automatically, no matter what the S&P 500 did that morning. Your financial life runs on a weekly cycle. So why would you build a portfolio that pays quarterly? Josh asked himself that same question. 4 dividend payouts a year. Meanwhile, he was making over 50 payments out. Rent, utilities, food, insurance, spread across every single week. His portfolio was generating income, but it was arriving in chunks, months apart, completely out of sync with how his money actually moved. That mismatch isn't just inconvenient, it's a structural problem. When income arrives quarterly, most people spend it all at once. Or worse, they don't feel it at all. It gets absorbed, disappears. But when income arrives weekly, it changes your relationship with your portfolio entirely. It feels real. It feels like a paycheck. And that consistency is what keeps people invested through the hard stretches, when markets are rough and impatience is loudest. And the good news? You don't need to overhaul your entire portfolio to get it. You just need the right system, built around the right calendar. Josh found it, and it starts with 12 stocks. Here's how it works. Most people build a dividend portfolio the same way. They find a stock with a strong yield, they buy it. Then they find another one, buy that too. Stack enough of them together and eventually income starts coming in. It works, but it's random, uncoordinated. Like hiring 12 workers and letting them all show up whenever they feel like it. What Josh built is different. It's a rotation. A deliberate schedule where every stock has a specific job, defined not just by what it pays, but by when it pays. 12 stocks, 3 groups. Each group covers a different set of months, each stock assigned to a specific week. Think of it like a relay race. One finishes, the next one picks up, and the baton never hits the ground. What makes this smart beyond timing is diversity. Each group covers a completely different set of industries: mortgage REITs, energy pipelines, shipping, finance, and real estate. If one sector takes a hit, the others keep the cash flowing. Diversification is built into the calendar itself, not just the ticker list. Equal investment across all 12 positions holds it together. No single week carries too much weight. Every position pulls its share. Then there's the compounding layer. Most of these companies offer DRIPs, dividend reinvestment plans. Instead of taking the weekly cash, you use it to automatically buy more shares. Those shares generate their own dividends. Those dividends buy more shares. The weekly income grows without adding a single dollar of your own. This isn't a stock list, it's a calendar. Every week of the year already has a stock assigned to it, a job to do, a payment to deliver. Now, let's look at what's inside each group. Let's start with the first group, January, April, July, and October. These 4 months kick off the rotation, 4 stocks, 4 weeks, 0 gaps. Week 1 goes to MLPR, E-Track's quarterly pay 1.5 times leveraged Illyrian MLP Index ETN. It tracks the biggest energy pipeline companies in America. These are the businesses that move oil and gas through pipes across the country. and they get paid whether oil is up or down. MLPR takes that income and amplifies it. 9.32% yield. The month starts here. Week 2 is RMR, the RMR Group. It manages over $40 billion worth of real estate, hospitals, hotels, office buildings, senior living. But RMR doesn't own any of it. It runs it. Think of it as the company behind the landlords. That management fee model pays a 10.99% yield. Week 3 belongs to SEVN, Seven Hills Realty Trust. It lends money to commercial real estate projects, storage, industrial, medical offices. And as a first mortgage lender, SEVN gets paid before almost everyone else in the deal. That's what makes its 13.08% yield, the highest in this group, more stable than it looks. And week 4 goes to PAA, Plains All-American Pipeline, one of the largest pipeline operators in North America. It moves energy through a network that took decades to build and would cost billions to replace. PAA has the lowest yield here at 7.99%, but it's been growing that dividend. What the others have in yield, PAA makes up for in growth. 4 weeks covered, every position doing its job. I will show you 2 more groups, and at the end, I'll show you exactly how much cash this system puts in your pocket, between $250 and $350 every single week of the year. But first, 2 more groups to build. Now, most investors don't think of February, May, August, and November as big dividend months. In this system, they are. Week 1 goes to AOMR, Angel Oak Mortgage REIT. Traditional banks have been tightening their lending standards for years. Angel Oak stepped into that gap, serving borrowers who don't fit the conventional mold but are still creditworthy. That niche generates strong, consistent cash flow, and as a REIT, it's legally required to distribute the majority of that income to shareholders. The result is a 14.92% yield, the highest in the entire portfolio. This is how every one of these months opens. Week 2 is AB, AllianceBernstein, a global investment management firm overseeing over $700 billion in assets, pension funds, endowments, sovereign wealth funds, insurance companies. The model is simple. As long as people need their money managed, AllianceBernstein gets paid. Markets don't need to go up. Assets just need to stay invested. That stability funds a 9.78% yield. Not the flashiest name in this group, but it does the job well, and that's exactly why it works here. Week 3 belongs to FLNG, Flex LNG. It owns and operates a fleet of modern LNG carriers moving liquefied natural gas across the globe. Europe is shifting away from pipeline gas. Asia's energy demand keeps climbing, and LNG shipping is the bridge connecting supply to demand across oceans. Flex LNG's contracts lock in revenue years in advance, which means the income isn't guessed at spot rates every quarter, it's contracted. 10.98% yield. And week 4 goes to ARLP, Alliance Resource Partners, one of the largest coal producers in the eastern United States, with extra exposure to oil and gas royalties. Coal doesn't make headlines, but ARLP has paid and grown its distribution through multiple energy cycles, backed by long-term supply contracts with utilities that need reliable, affordable baseload energy. 9.06% yield closes this month out. 4 weeks covered, and the final group closes out every quarter: March, June, September, and December. This is the strongest of the 3. Week 1 goes to LFT, Lument Finance Trust. It focuses entirely on commercial real estate debt with a heavy emphasis on multifamily housing, apartment buildings, housing communities, the kind of real estate that never goes out of demand because people always need a place to live. Lument doesn't own the properties, it finances them, originating floating rate mortgage loans that generate consistent interest income. That income flows directly to shareholders at an 11.59% yield. In the second week, it's FDUS, known as Fidus Investment Corporation, a business development company that provides debt and equity financing to small and mid-sized businesses across the country. Think of it as a private lender for companies that don't have easy access to traditional bank loans. They need capital to grow or restructure. Fidus provides it at strong interest rates. As a BDC, it's required by law to distribute at least 90% of its taxable income, 12.03% yield. Week 3 belongs to TRIN, Trinity Capital, another BDC, but with a sharper focus. Trinity specializes in venture debt and equipment financing for growth stage companies, businesses backed by venture capital that need working capital without giving up more equity. Because institutional investors typically back Trinity's borrowers, the credit quality tends to be stronger than traditional BDC lending. 13.79% yield, the highest in this group. And week 4 goes to NLCP, New Lake Capital Partners, a cannabis-focused real estate investment trust. This one raises eyebrows at first, but here's what makes it work. New Lake doesn't grow or sell cannabis. It owns the real estate that licensed operators use to do business. Triple net leases, long-term contracts. Tenants cover taxes, insurance, and maintenance. New Lake collects the rent and passes it to shareholders. 11.24% yield closes the month. That's all 12 stocks. Every week of the year is covered. 3 groups, 3 different income levels, rotating through every quarter. Before we get to the numbers, here's how Josh sets it up. The first decision is position size. This portfolio works on equal weight, the same dollar amount into each of the 12 stocks. If you're starting with $120,000, that's $10,000 per stock. But you don't need $120,000 to begin. Start with what you have. Focus on one group. Build the first 4 weeks, then add the second group when you're ready. The system is flexible. What matters is getting started. The second thing to watch is the ex-dividend date. This is the cutoff. Own the stock before this date and the next payout is yours. Buy after it and you wait another quarter. Mark these dates. Set a reminder. Missing an ex-dividend date by a single day means waiting 3 months for the next one. And third, decide what to do with the income. Take it as cash and it covers your expenses that week. Turn DRIP on and every payout automatically buys more shares. Those shares generate their own dividends. The weekly income grows without Josh adding another dollar. Josh sets equal positions across all 12, marks every ex-dividend date, turns DRIP on. This is where it all comes together. Let's talk about what this system actually puts in Josh's pockets. Every month in this calendar falls into one of 3 income levels, and they rotate with the same predictability as the stocks themselves. January, April, July, and October run on Group 1. 4 weeks, 4 payouts, $233 in Week 1, $275 in Week 2, $327 in Week 3, $200 in Week 4. That's $1,035 every time one of these months hit, with a weekly average of $259. February, May, August, and November run on Group 2. These are the months AOMR opens with $373, the single heaviest week in the entire calendar. AB follows with $245. FLNG adds $275. ARLP closes with $227. Total for the month, $1,120. Weekly average, $280. March, June, September, and December run on Group 3, the strongest group. LFT opens with $290. FDUS follows with $301. TRIN delivers $345 in Week 3, the biggest single week number anywhere in this system. NLCP closes with $281. Total for the month, $1,217. Weekly average, $304. Add it all up across 12 months and this system generates $13,488 in annual dividend income. That's over $1,124 every single month on average, landing week after week in every season through every market condition. And that number assumes Josh never adds another dollar, just the original positions, the rotation, and the reinvestment doing its work in the background. Now think about what happens when DRIP is running. Every payout buys more shares. Those shares generate more dividends. Those dividends buy more shares. If you want to see how $35 a week into Vanguard index funds grows into over $8,000 a month in passive income, click the video on screen to find out how.